Good day. My name is Michael Madwell, President of the Sovereign Wealth Fund Institute, SWFI. Today I'm going to go over the SWFI Global Asset Owner Survey results for the third quarter of 2020. In this survey, we got a lot of responses from sovereign wealth funds, pension plans, endowments, and the like. If you have any questions on what we do and our organization, you can always go to swfinstitute.org, and that is the public-facing website. Our main line of business is the research terminal, which is swfi.com, and that terminal includes information on sovereign funds, pensions, endowments, family offices, tracking their asset allocation data. Now, a few things about this asset owner survey. We only question and survey public asset owners, sometimes private foundations and family offices, but mostly asset owners. So no fund managers, no broker dealers, no private equity firms. And we ask them similar questions every quarter. And what we're trying to do is track the sentiment change over a period of time. And yes, at times we do have to add in answers. For example, the coronavirus was a major game changer this year, and we added that to the questionnaire. So it's really rare circumstance that we add these types of questions in there. The survey, again, is published December, March, June, and of course this September. And if you want to participate in the survey, just go to research at swfinstitute.org, and we're looking for CIO level, sometimes board, all the way down to senior portfolio manager. So somebody who has a decision-making process, that's what we're looking for to capture in the survey, okay? So a few things that I want to highlight is that the survey this time is really interesting because we've seen some changes. So let's go through some of the questions that we ask. The first question is, what do you think is the most crowded trade? And for this year, and for September 2020, this quarter, and again, the survey was taken August, so September is when this is released. Long U.S. technology equities is the most crowded trade by far among all the respondents. And second place to that is long U.S. and EU bonds. And if we go back in June, again, the same answer was long U.S. technologies. Back to March, long U.S. technologies. It wasn't December 2019 that the most crowded trade was long high quality equities. So people think that there's a lot of crowded trades going to tech, and no doubt, if you look at any pension sovereign wealth fund, many of their public holdings, you'll see Amazon, Facebook, Microsoft, Alibaba, JD.com, etc. Okay, so that appears to be the most crowded trade. Another question we ask is, what do you think is going to be the biggest driver of stock prices in the next 6 months? What's going to be driving the markets, right? Again, public stocks. I'm not talking about other types of asset classes right now. And the answer for that one is the pandemic and quarantine end. And this question was a sample option in March 2020, and in June 2020 was the most popular response. In fact, though, this number did tick down percentage-wise, still the most popular for September, but other questions, the other responses went in, such as company earnings and treasury bond yields are also drivers of listed equity. But again, by far, percentage-wise, pandemic and quarantine end. And what that tells us is that sovereign funds, pension plans, the ones that have large pools of cash, I'm not talking about the smaller ones where there's liquidity issues, they are looking for answers from the government, private sector when it comes to vaccines, and also behavioral changes. How are people going to change their behavior once things open up, right? I mean, we could open up and people are still kind of freaked out about things. And that pertains in consumer trends. That could also be with business-to-business meetings, due diligence, fund manager meetings, etc. So very interesting, still a major concern. So let's keep going down the list here. What's the biggest tail risk for this quarter, August to September 2020? What's the biggest tail risk? And the number one biggest tail risk actually remains the viral outbreak and pandemic, but barely wins. The next popular answer was trade wars and increased protectionism, followed by a stock market bubble. Compared to last quarter, by far, viral outbreak, by far. And in the March quarter, when that wasn't an answer, trade wars and viral outbreak were pretty close. Trade wars by hair, but viral outbreak, it was an other, so people had to fill that in. So let's go back to the September results. So the viral outbreak is the biggest tail risk, obviously. Okay, we already talked about that kind of in the last question. Trade wars and increased protectionism. This is a very big issue. And we've already seen it happen. In fact, the survey answers before COVID, this was the biggest area by far. And what investors are worried about is the bifurcation, China-US relations, and how that is changing. There's a digital divide. I mean, if you don't know, it's very obvious. Huawei, 5G, you have WeChat, CFIUS, TikTok, right? I can go on and on here. But even more granular, the chip companies, we can go into the Chinese listings on NASDAQ and those types of things, right? But whether it's the Trump or Biden they're running neck and neck in this election here, this will still be an issue. In our analysis, we think that a Biden win would probably be less aggressive with China versus a Trump win, just because of what we've seen so far and the rhetoric and the types of people that they would bring into their campaign. And so, again, this acceleration of trade wars are how our sovereign wealth is playing with this. So you have some sovereign wealth funds like Temasek Holdings or sovereign investors where they're putting a lot of money into China, and they're also putting a lot of money in the U.S., ignoring everything in between. You have some countries going U.S., dropping China stocks, while a lot of Canadian pensions, they still have a lot of presence in China, and they're even going more into China, going to Alibaba and elsewhere. And actually, a lot of Canadian pension plans have or open sell offices in Hong Kong, where there was a lot of political strife, still kind of is because of the security law stuff, but kind of died down with COVID, right? So very fascinating. That's kind of the big unraveling tail risk. And then the stock market bubble, because what every central bank did was, print money out, right? We wanted to prevent contagion. We wanted to keep things going, right? So we're just going to bring up that bar tab. And already the Federal Reserve probably owns about a third of U.S. mortgages, kind of the trend a while back, right? There's all these facilities. There's even, munis, etc. And that's a huge debate that I don't want to go into right now. But again, big tail risks here. And right, stock market risk. Everyone is, a lot more people are putting money in the stock market. We have Amazon, Apple, SoftBank did a big play. And all those stuff, the commentary is going to be in this survey. So that appears to be, and again, what I love about this survey is that we get it from the asset owners, not from the managers. Managers want to sell you products, solutions, etc. These are from the fiduciaries, the asset owners, and they're telling us what they're looking at. Okay, let's see. With regard to earnings expectations for listed companies, do you think they're going to improve by more than 10% in the next 12 months? Will earnings improve for stocks in the next 12 months by a 10% kind of margin? So this is a bullish or bearish signal. For September 2020, 41% answered yes, 59% answered no. This is a huge turnaround. So investors are more bullish on earnings in the stock market, which earnings is kind of a tale of linking to stock prices, right? So in June 2020, only 28.2 said yes. In March, when COVID hit, only 9.4, knowing that everyone's earnings would be smashed, right? Before COVID, it was 17.1, and in September 2009, it was only 7.1. So people, even back then in 2019, dropped stocks. They unloaded, got their profits. Many pensions and sovereign funds took their profits before 2020 started. And they were like, this can't go on any further. But yet COVID happened. If you didn't get all the way out, smashed you. And now there's optimism is back up again, right? This optimism this level is probably mimicked between September 2018 and June 2018. So ever since kind of the end of 2018, investors haven't taken their profits. So let's move on to the next question. Which, in this current environment that we are in today, which potential risk is the greatest towards financial market stability? All right, which risk? And some of the response are geopolitical risk, business cycle risk, credit default risk, interest rate risk, counterparty risk, viral outbreak risk. Of course, that's number one. Number two is geopolitical risk, which ties into the U.S.-China theme going on. And then you also have the Middle East and some things going on there, but U.S.-China here, Middle East here, and then the Brexit stuff's kind of settled down a bit there. But that's kind of the overlying trends. The quarter before, actually, geopolitical risk was actually more than the viral pandemic risk, just by a hair. So we can see that these are the two risks that asset owners are really thinking about in the forefront that could really disrupt financial market stability, right? I mean, what happens if the trade war even intensifies with China? There could be more embargoes. There could be completely all Chinese companies could be out of the U.S. stock market, and then there could be retaliation. And there already is retaliation efforts going on right now. And there's a realigning of the map of the alliances in the world and where things are going. I mean, a lot of the institutions that people grew up with who are now retiring, the Cold War era institutions, NATO, on the military front, you have I can go down the whole list here. They're being reshaped and reorganized and trying to find a purpose of where they fit in this new kind of paradigm world, right? And it's also a generational shift to the mindset of the people, the zeitgeist, how people see things and what's acceptable, and the norms are changing. And that's something that, again, follows this whole trend here. I mean, we're talking about ESG, how that's becoming a very serious topic today. When I was in this business, it was kind of a thing for, hey, I don't want to get involved in these sin stocks, right? So another question we ask is, as an asset owner, what do you want to see companies do with their cash flow? Stock buybacks, improved balance sheet, capital spending. And the number one issue in the last, I think I'm looking at this few surveys since I think 2019, is improve the balance sheet, okay? Repay your debt obligations, pension solvency issues. Just make sure you can stay in business, Return cash to shareholders wasn't really that big, so the buyback thing is not that big. We added build cash reserves after the COVID, so that's kind of new, and so that kind of picked up some steam. So collecting cash, right? And then increased capital spending, very little. I mean, that's actually, it's a little bit above the return cash to shareholders. So it's interesting how the returning cash to shareholders companies, owners actually want balance sheet improvement. That's the number one thing. So that's very fascinating. So they don't want to lose anything there. Okay, here's the fun stuff. We're talking about general asset allocation questions. Underweight, significantly underweight, same, overweight, significantly over. I'm not going to go over all of them. I'm just going to highlight some of the ones that really stood out. Cash, people are kind of more of the response are going to overweight cash. Makes sense, whether it's liquidity issues or being opportunistic. I mean, there's tons of capital out there on the marketplace held by fund managers, but that is another possibility there. Passive fixed income, significantly underweight. So passive U.S. fixed income, not popular. Emerging market debt, no one's really excited about it. Credit strategies, again, are still hot. A lot of investors are bullish in credit strategies. A big change that we saw in this quarter is active U.S. equities and active global equities. So going back to the stock market, and that kind of is linked to how the stock market went down so much in COVID and then went right back up, right? And then you also have central bank policy playing into that as well. So money is flooding back into equities and seeing some of that, seeing some advantage there. And that's why we see optimism in active global equities and those other ones. Real estate funds, real estate investment trust, no. Private real estate, yes. We should probably be more specific in what types of private real estate. In our transaction database, we're seeing a lot of plays in logistics. This is a no-brainer, right? I can go to the e-commerce story. Data centers, right? Big data. More data is being needed for things, right? And as technology changes, people are having censoring everything, right? Not censoring, but sensing, right? Gathering that information so you can better market to a client or end user or getting better intel. We see concerns in student housing. Obviously, that's a concern. Also, obviously, in office and retail, that is a big mystery. And how actually, I was in a conversation with someone who's a very large tenant down on Wall Street, and they were saying, "Hey, we might not come back to the office for another year, but we might not need all the space." And so, who holds those assets? REITs, large investors, real estate funds, some wealthy families, right? So they are looking at how that's playing out, and all of the trends that people are moving out of the cities in the states. New York, I'm up here in the Northwest. People are going to the suburbs, and so how is that going to impact the workforce? I mean, what happened to WeWork, right? And these types of things. Let's go down the list here. Private infrastructure. I don't think I've ever seen a underweight on private infrastructure. Now, this will be fascinating to see the outcome of COVID, right? How are airports doing? Not well right now. Gatwick in the UK, all the airports in the UK have asset owners, superannuation funds as investors. So that will be interesting to see how that pans out. Private equity, obviously that's still a favorite asset. Gold, a little bullish, but not that much. Commodities, still not there. Was doing worse a while ago. Hedge funds, actually a little better this quarter. And some people might have private credit funds considered hedge funds, and so that might be a false signal there. But there is some demand for hedge funds, global macro, event-driven, opportunistic hedge funds. All right, let's talk about geographic asset allocation, right? Here's a world map here where you can put your money, what areas where you see a lot of growth. Let's start with the big areas first. So U.S., solid trend, quarter after quarter, liquid market, dollars the world reserve currency, private property rights, innovation, etc. So the U.S. is there. Not much negativity on the U.S. The U.K., underweight the U.K., more than overweight. Europe, ex-UK, opposite way. Actually, people probably see a bottom in Europe and probably see buying opportunities. So we're seeing some overweight in Europe, ex-UK. Japan here, it's actually underweight. So Japan actually had a few good survey quarters, but I think it's underweight now. And now China is overweight. So, and they had a fast recovery from COVID, and there's a lot of optimism there. And let's not forget, the people that fill out the survey, not everyone's U.S. centric. We have people filling out the survey from Africa, the Middle East, Asia, Europe, right? So again, seeing China stronger there, because a lot of U.S. pension plans don't have direct exposure to China. They have sort of an emerging market manager, right? India, it's kind of less. India used to be really bullish, but it's kind of going downwards. Rest of Asia is mixed. Canada is underweight. Australia is underweight. Africa is underweight. Middle East, really underweight. Latin America, really underweight. Mexico, really underweight. Brazil, Latin America ex-Brazil is really underweight. Brazil, underweight. So pretty much all of Latin America is massively underweight. There's a few optimistic players out there, but not that many. And then actually Africa is faring better than Latin America in terms of where you can put your money. So it's really interesting. So, I mean, taking a totality of this, US, Europe ex-UK, China, the three winners. Europe ex-UK, rest of Asia, kind of in the middle stack. Canada, Australia, UK, Commonwealth, no, lower than that. And then you have Africa, Middle East, and then below Latin America. So very interesting to see where people want to put asset allocation and where they're going to put their money. All right. And this is a a much more narrower response is, with regard to listed equities in the next 12 months, do you plan on? So within public stocks, right, which areas are going to be the most overweight? And we see IT and pharmaceuticals. Well, those are pretty obvious ones. Pharma, you have COVID, cancer therapies, etc. And then IT, just the, a lot of the ways where it's a very high margin business. However, the risk with the middle market to small cap IT is that you have functional obsolescence, but at the same time, all these small caps get bought out. The biggest underweight is energy. So energy and real estate, those are the biggest underweights in stocks. And let's go over the sample here. Just the majority of the sample is between, actually it's pretty good. North America is a big anchor, obviously, but then it goes Europe, Asia, Middle East, Africa, kind of in this realm here. That's typically how it is pretty much many of the quarters. So the AUM tabulated rough estimate, again, it's about 2.56 trillion. That's kind of what we tend to guess between 2 and 3.4 trillion is the sample size of this. And our responses are a lot less than the annual surveys that people put out. And that's just because this is more frequent, but we're getting a pulse all throughout the year because things happen, right? We don't live in a vacuum. So with that being said, this survey, we hope that you want to participate in. If you are an asset owner, right, please reach out to us. If you fill out the survey, you can get a copy of it. And you first want to get a copy of it. And then it goes to our subscribers on SWFI.com. And then we release nuggets like this. I'm doing a little video cast here, right? And I'm going to talk about it. So with that being said, I hope you have a great day. And if you have any questions at all, just go to our public site, swfinstitute.org, and reach out to one of our staff members. Have a wonderful day.